Good afternoon and welcome to Chicago, Future of Finance. I'm Oliver Rennick. It's Thursday. Stocks are pretty solid right now. VIX dropping back down. Crypto slipping, oil's flopping, plenty of geopolitical drama, but oil just generally looks weak. Equities, though, being led by semiconductors. That's a big deal. It's basically your guidepost for markets. I told it to Jeff Snyder last week in an interview I did on Friday about last year and the year going forward, which was what's the one group to watch? Always, basically, no matter what happens, is semiconductors. So that's the lead story of the day is SMH is at all-time highs. That's pretty good stuff. What else can you look for in terms of trend and in terms of finding confidence about the market after a little bit of a hiccup there that we had yesterday? Volatility kind of awoke a little bit, but this is the most important chart up and to the right. SMH, a real thing of beauty, a bit of a red candle, but a gap up too. Notice there had been a range right below 395 that had held pretty well. So maybe 390 actually even. We had trouble really getting above 390, but at the same time, for SMH, the obviously most popular semiconductor general ETF, you also didn't really have any weakness strong enough to push us lower. It was range bound and now we break out. That's a nice little pop out in the candle. Again, these are simple signs that things are pretty good and stable in markets. You have cryptos giving back a little bit. Do think that's a notable event, but still after yesterday's move, BTC got above 95,000. That's an important part of that range. So it hasn't hit 100 yet. That's generally been my view on where Bitcoin could go, likely to retest 100, or if you zoom out and you're looking for the longer term trend line, then maybe BTC could cruise back somewhere to 110 or something like that. But we've got other things on our mind as well. We're going to be talking economics. We do have a pretty notable string of data from this morning. I do think that figures on manufacturing from Philadelphia were important, especially also when you pair it alongside the Empire State Manufacturing. That's two prints that were pretty good. So just looking at those real fast, Empire State at 7.7. Obviously, this is not exactly the big blockbuster number that moves markets a ton, but when you combine it with another manufacturing print from Philly at 12.6, two good prints on the same day for the category of the economy that has been in contraction for PMIs under 50. So if manufacturing picks back up, I mean, really anything is possible here. Market seems to more have been in a state of churn with things like Bitcoin trading places with stocks, basically. That's kind of what we had for a day where Bitcoin bounced and then stocks took a break. But again, when I think about what matters the most, it's semiconductors all the way. I'm also watching the 10-year yield, which has remained quite stable under 4.2%. That's another really big one that could have given us some trouble, but hasn't. So you just really have a pretty stable backdrop here. And despite some concerns about what could happen on the geopolitical stage or maybe drama at the Fed, I think the latter is more important than it is on the geopolitics. But we are going to talk some fun geopolitics trades. I think trading stocks in the geopolitical realm makes a lot more sense than trying to trade the index in the geopolitical kind of catalyst realm, because there's just so much else that drives the index, namely tech, namely innovation. By the way, Google's Gemini is still expected to be the #1 AI by the end of the year. That's a current Kalshi bet, and Alphabet looking like that is living up to that expectation. This is a really beautiful chart. Keep in mind that it's a standout in the MAGS world, where that ETF, MAGS from Round Hill, as good as it is with some of the biggest names, has just been stuck now basically since September. So another one of the themes we're going to talk about today is rotation. That's a big deal as well because the IWM is ramping up. We've talked about this with Danny Kirsch a good bit at Piper, who's coming back to us today, as well as Noel Smith, who's had his eyes on potential for some shakeup a little bit. You know, we were also talking silver too, which did have this wild candle on it today. We're going to make sure we want to hit that as well. But the last thought that I have on the 10-year is that as long as we're staying below 4.2% and data are coming in generally solid, then you're in a pretty good condition for the market overall. Maybe we just needed to have vol kind of pop a little bit to get in line with what was happening underneath the surface with a little bit of churn here and there. Mr. Noel Smith, Convex Asset Mgmt, Las Vegas based, joins us on the Zoom. What's up, Noel?
How are you? It's 70 and sunny here today.
I know, man. I'm actually working on booking my next Vegas event. I'm going to be out there for the Money Show. I think that's next month, February. So sooner I get there, the better. My knee is almost healed, so I'm ready to get up on the slopes this time.
Well, we can make sure that that gets fixed and we can hurt it again.
Exactly, a fresh slate to break. All right, so
Yep.
look, on the surface, Noel, it's kind of a calm day of volatility for VX futures, 15.6. VIX right now, what are we at? 15.6, high 16.5 of the day. So, look, markets continue to grind. I think there's a lot of interesting things underneath the surface, even though that looks kind of boring up there.
Well, from a vol standpoint, there's really not a lot to be concerned about in the sense that if you were trying to make a decision and you take all of these ideas and you aggregate them into something that's actionable, I think the stance is risk on. I think it also, because vol is relatively low and you look at correlations being relatively low, it makes sense to have some hedges here. I've been eyeballing and doing some VIX out of the money call spreads recently. I still have some HYG put spreads. Neither one of those are making money today. So,
Right.
your guess is that.
Flat though. I haven't got, I do think you're barking up a good tree though with HYG, Noel, because there is this very marginal lower high in the chart, but it just hasn't broken yet. And I gotta say, if you look at regional banks looking pretty good, I don't know, your HYG trade might not have long here.
Well, like I said, I'm long put spreads. So,
Okay.
that's that. What I want to have happen with that spread at least is for the market to go, or for that instrument to go down. But if you look at a cross asset vol standpoint, you've got really everything's fine. Gold vol is in, silver vol is in, even though we had a change in the way that margin is calculated at the CME with the earnings this morning. I mean, really everything for the next handful of trading days is going to be about earnings. And there's a lot of bullish catalysts on the horizon. And if you're wrong, this is a really good time, a really good place to add some hedges.
Okay. And that's a key point as well, is you're not like thinking, you don't have this big bearish view at all. You're just saying that if you generally want to have a hedge to your position, there might be ways to do it that are kind of appropriate based on, the timeline of events here. So if anything cracks in earnings, the stuff that'll get hit is probably higher yield, is lower quality, generally, if it happens. So far, it hasn't.
Correct. And also from a correlation standpoint, if you think about earnings seasons, typically, you have something go this way, something go that way, and the index might go right in the middle. So this is a good time to have on correlation bets. Correlation is really low. So from an absolute standpoint, it's at very historic lows. But a lot of times during earnings seasons, everything does do its own thing, and the index as a whole doesn't really have a whole lot to say about it. So it's something to consider here as well.
Yeah. We've been talking about that this week. That's a really important one. I'm glad you bring it up. That's been a major theme, is low correlations. And it did normalize a little bit yesterday. If I go here, I've got Core 1M up on the screen. When we had that little drop in markets, correlation normalized. And that's one way, I think, to explain what happened here, Noel, is that certain elements in the volatility regime just kind of needed to reset a little bit.
Barely anything, man. As much as I want to try to give somebody, right? I want to try.
And it reversed back today. To be clear, you're totally right. It reversed right back today.
I do an interview like this, and I want to try to give somebody something cool to listen to, and come up with some really unique idea. But the data doesn't really bear this out. There's not any kind of big macro event. Of course, there's geopolitical stuff, but everybody kind of knows the same stuff. So when it comes from a vol standpoint, what is the market telling you? The market is telling you that things are pretty stable. Correlation isn't bid. Vol isn't bid. Cross asset vol isn't bid. Bond vol certainly isn't bid. We're talking about 2 rate cuts this year, and who knows what happens with that, right? If is Trump going to put Powell in jail or something? That's crazy. I have no idea. But there's really no market data that is showing you that, hey, listen, people are freaking out about this, or at least thinking about freaking out. So I got to tell you, risk on is the way to be.
I really like, I'm blasting this out on X right now, because I do really like your kind of idea here, Noel, which is that if you look at the index level, you don't lie, the charts don't lie, you can't fight the trend, but you can also express it, I think, in specific ways that make a lot of sense, which is basically be long semiconductors. You get a little bit of beta to the overall stock market, and then like SMH up more than S&P last year, but it also hasn't really broken the trend. So it's not like you're gambling in the highly speculative category, and you're hitting where the earnings growth is. You're hitting the AI stuff right in its core still, and then if you want to hedge it out, either buy volatility for cheap or buy an HYG, spread or something. I think those two things pair fairly well together.
Exactly. I think, you cruise down the road, but you put on a helmet, so you have
Cruise down the road
some
in
kind
SMH.
Right, with a sensible trajectory, and if you're looking at having some hedges in case everything goes awry in a really fast environment, put on some upside calls in VIX or something like that. Maybe some downside puts in SPX or SPY, it's just in case everything goes against you.
Yeah. And the other thing too is that, when we look at the numbers coming out, from banks versus big tech, for the most part, they're all just kind of solid across the board. And those are two really important groups that, we had that Bank of America sell off and it's stabilizing today. But if I look at XLF, if I look at KRE, these are either bouncing right off their short-term 50-day moving averages or they are extending it. So there's some, broadening arguably happening here.
That's exactly right. So if you look at the market, everything is broadening. You've got, a little bit of Google on the downside, Apple on the downside a little bit, but things are just doing, if you're just looking at it from a statistical standpoint, it's a totally normal day. There's not a whole lot to look at today and be like, oh my gosh, you got to figure out some new plan. So again, vol is in, cross-asset vol is in. I think it's a good time to add some upside hedges in VIX in the case that, the index does get punished, but there's really no good case for having a risk-off posture here that I can see.
Okay. So, it never hurts to wear a helmet, right? We learned that riding the bikes. Learned that very clearly. But what else did we say when we were on the lift? Biking and risk management, right? It really is about risk management. So you want to have a good time, but you also want to make sure you got a helmet on. The Bitcoin and the crypto stuff looks like it's basically random at this point. I don't even know where that fits into the analogy, Noel. That's like a whole other sport, a whole other game, a whole other track. They firmed up yesterday, but then gave it back today. So, I think it's just a lot of chop. I don't know what to do with it. I guess if you want to sprinkle on more risk appetite, I still generally view it that way. Any thoughts on how that kind of overlaps with this?
I look at the data, and if you see something like the TQQ relative to Bitcoin, those two things map fairly similarly. So that echoes your standpoint of, is Bitcoin really just fancy turbo risk? Kinda. But why did it go down? Why did it go up? Is it an inflation instrument? Well, you would say if it was, what's up with gold and silver going to the moon with Bitcoin is not going to join it? So the narrative has been shifting. I've been paying attention to Bitcoin since it was sub $1. So the narrative has shifted so many times as to, I don't want to be like, Peter Schiff that's a Bitcoin hitter, because I'm not. But it's not always the same. So as to why it was up the past few days and why it's down today, I have no idea. From a volatility standpoint, it's come back in, and you can make a case for saying it's going to go back to 100,000 or something. Okay, so what?
My old colleague Alex Coffey at Charles Schwab always had a great way of describing Bitcoin, where he viewed it as just a volatility substitute. So when VIX gets low, it's just the same, framed in just a different way. Exactly what you're saying, exactly what I think I'm saying too, just framed in another way, which is that when volatility is low and people are seeking volatility, they want volatility, they want risk, that's what really excites Bitcoin. So from that perspective, it might be something that really awakens if we get major vol crush back down sub 15 or something like that. But the last 10 days, as we can see on this chart, really longer, Noel, 30 has been about VIX creeping upwards. So I don't know if you think, 15 kind of seems a far ways, below 15 kind of seems a far ways away right now. It's like 4 days.
I think it's been creeping up a little bit, but creeping up from where to where? We're talking, from 14 to 15.
Yeah. Yep.
Not that crazy, right? So the idea that it goes from 15 to 20, that's a piece of cake. No big deal. But if it goes down to 12, what do you think is going to happen to SPX or SPY? It's probably going to go higher. So to repeat myself, I think that, having some, market longs, whether they be in semiconductors or banks or whatever, this whole earnings season, but having some kind of risk on posture, but then having some kind of an out of the money with a relatively small hedge component is a very sensible idea.
Yeah, sensible indeed. The epic climb of VIX from 13.4 to 15.8. Yeah, I think obviously you break this red line on here to the downside. S&P probably turns 7,000 into support from resistance, and Bitcoin probably wakes up too. To close it out though, Noel, because I know Danny Kirsch is going to want to chime in on some of the vol stuff. Let's talk commodities, as you brought up, Noel. We talked about this last time. Tell me how you're thinking about this right now, the move in silver. which I think is still the most exciting. Maybe copper's got a little juicy with Chamath Palihapitiya tweeting about it.
I mean, these things have been unbelievable performers. We have a gold position, a long gold position. Great. Gold vol is coming in nicely today, which is great. We also have some condors on in gold. So gold volatility, we're short there. So I do expect some kind of a compression if you're going to consolidate. Insofar as silver goes, I'm just basically long some puts. I don't want silver to go down. I don't have a dog in this fight in the sense that I want silver to go to 100 or 50. I just was looking for some, profit taking or risk increases from the CME, and it looks like we did get some of that. They changed their methodology, but it's not enough to really do much in silver. So I don't expect my small little wingy puts to pay out, but they're there in case silver does crash. But as to why it's going up, it's kind of sniffing out, I think, the ongoing sense of everything that the government does probably has some kind of an inflationary aspect to it.
Yeah,
I think that's the narrative.
Somebody in chat asked how much is metals exports contributing to the recent data showing lowest U.S. trade deficit since 2009 and expected to beat fourth quarter GDP. I think there's probably an impact. I was actually just checking the Kalshi odds on GDP probabilities, and they haven't moved a lot over the last week. I'm kind of surprised. I would think they should be moving a little bit higher based on the data that we've seen. By the way, the Philly and New York export, the manufacturing numbers I talked about earlier, those don't go by the same PMI metric. Somebody was asking about that as well. So, we've got much lower numbers there. But I haven't seen anything troubling from the economy at all, Noel. I think that if GDP revisions start going higher, then maybe you'll get yields finally crossing 4.2%. But otherwise, it feels like all good news to me.
Yeah, but if Powell's out, assuming he doesn't go to jail first, if Powell's out in May anyway, and then he puts one of the two Kevins in, he's got 350 basis points to play with. So say GDP starts to get a little softer, or whatever else. Can he jack rates down another 100 bips, 200 bips? Yeah, he's got tons of room. He can run the economy quite hot. He probably would going into the midterms as well.
Yeah, that's when yields are going to blow out, right?
I would think so.
Yeah. I would think if you want to be short HYG, you want to have an expiry that includes the transition from Powell to one of the Kevins. That seems like one way to combine kind of everything we're talking about there. Great thoughts, Noel. Appreciate you as always. Somebody in chat said you're the GOAT. I love it. I agree. With us on Thursday afternoon, Noel Smith of Convex Asset Mgmt. Great stuff. We're going to take a short break at the Innovator Buffer break, 2 minutes. And then the great Danny Kirsch joins me. That means more options. It means more trades and a continued conversation about rotation. Join us from Piper Sandler, also a GOAT, up next.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovator's floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. Cboe is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Rennick, from Cboe, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago. All right, welcome back to Chicago Future Finance. I got Mr. Danny Kirsch on the line, joining us from Piper Sandler, another goated options analyst. Danny, thanks for being here, man.
Thanks for having me.
Our conclusion, I think, from Noel there, if I can summarize it, let's just put together a trade here to start, which is your long stocks in your core position via SMH, so you get the earnings. And if you want to hedge, you do it basically long put spreads in HYG, and you give them time and expiry to allow for one of the new Fed chairs to just blow out yields in the spring. What do you think?
Yeah, I mean, I some of the stuff he was saying, it's like I like it. I find myself not getting too worried about the market. I think the one thing that is a little concerning is like VIX futures positioning is massively short. So if you're thinking about how do you get a situation, you get a big vol move, but not necessarily a big equity move, and you could have like a August of 2024, where I think the S&P was down 3%, but the VIX got to 50. And that's the one thing that spooks me a little bit, that like the positioning looks very similar to July before this blow up happened. And it could be something where it's just a positioning driven sort of quick snappy unwind where it looks like vol massively outperforms. When I say that, I mean the VIX can go to 30 or 40 on a small S&P move, because like usually there's like a beta of the VIX to the S&P. This is where the beta could potentially outperform a lot, and that's just a function of positioning being so short in the VIX permanently. You know, that might not last. The expiry's in January. That's beyond
None of that got
it's
cleared out yesterday at all in that little pop?
Not really. I mean, a couple of it is like so January 6th was the last update, so we'll see. I think a week. I think it's either this Friday or next Friday we'll get updated futures positioning. I don't think so. And if anything, people were buying Jan VIX yesterday in February, so it wasn't like they were monetizing positions on the little sell-off yesterday.
Okay. I will say the futures chart versus the index chart looks slightly different, just because if you look at VIX, there is a pretty clear uptrend from late December, the stair step from 13.3 low to 18 high midday yesterday. But in the VIX futures, it's quite a bit more persistent in testing the 16 level. It doesn't really budge there so much on a daily basis. Any thoughts on that difference, Danny?
Yeah, I mean, so the spot futures will eventually fall into spot. Expiry's on Wednesday, so that'll collapse. Typically, like what we'd expect, like if I were to pitch a trade, I'd say, well, the VIX future right now is 16.5, the VIX spot is 15.5. Depending on the cost of the VIX 16 put, you maybe would buy that just to play the collapsing if it was like 10 cents or less. It isn't right now, so I don't think it's that interesting. That being said, we've been suggesting by February or March VIX calls, which we very rarely pitch VIX upside because it's a terrible trade that barely ever makes money. But again, it's just more a function of like positioning is so short that I think that the likelihood of a VIX spike is greater than a VIX crash lower from here, from these levels, and based on where positioning is. You make a lot more money owning VIX puts. You make a lot more money owning VIX puts than you do VIX calls over time, I would think, or VIX put spreads. That being said, I don't think this is the right time.
Fair enough, but that's an important point, right? Is if there is breakage, which direction seems more likely? Because there are other ramifications too. Because I was thinking about what could maybe put a fire under Bitcoin again, and maybe it's if vol drops below 14. Maybe. But right now, I would kind of think that you don't want to fight the short-term trend. Vol seems to want to creep a little bit higher, just not to a point where it's disrupting really anything on the index level.
Yeah, I think that's interesting. On like, is it lower VIX that gets people to buy Bitcoin? I think to some extent, you were talking about silver earlier. I think that's taken a little bit of the mind share as well. I've read articles about retail getting very active in silver. I'd imagine it's the same people. The other thought I had on Bitcoin, so IBIT was launched, what, like 15 months ago?
Okay, sounds right. Yeah.
That sound right? I'm guessing. I think it's something around that time. So IBIT, the Bitcoin ETF,
Yep.
and Bitcoin was
Yeah.
down last
January.
year. Yeah, so Bitcoin was down last year, and so depending on when you bought it, I mean, for the most part, unless you bought it at the lows, you lost money owning IBIT last year. A lot of the market was up. If you own Qs, if you own SPY, you had capital gains. I think to some extent, Bitcoin has sort of been an underperformer at the beginning of the year, especially into December, and even to start this year, it's done okay. It's you're starting to see this rally. I think it's been part of like this tax loss selling loser trade, and now you might see money slowly flow back in, and that I think is going to play out over the next month or so. Because if you sold anytime in December, it's like now we're at January 15th, so now maybe you're looking at buying back in. You don't want to obviously have like a wash sale issue, so you got to wait your 30 days. And I would think that there'll be incremental buyers of people who sold in December of last year to take the loss to get back in. So I find myself pretty optimistic Bitcoin, especially like relative to like a silver or gold in the near term. Not to mention you have, I thought it was kind of shocking it wasn't rallying on Sunday around the Powell news. Like you
Right.
think Bitcoin should be a huge beneficiary of like a weaker
Sort of little
dollar.
life next day, right?
Yeah,
Sort of little life
it
next day.
it was delayed. I mean, today it's down a little bit, but I think it's like an interesting time to start looking on the long side there, especially following the inflation data as well.
Look, the fact that it's going to lead to, I don't really, here's my view on the Powell and Bitcoin connection. It might seem unnecessarily subtle, but it's a bit of a hairline kind of difference, is that the idea of president and Fed going against each other being positive for crypto, it's going to weaken the dollar. I don't really buy that. What I do buy, though, is that, like we were talking about also in the last block, is he's going to put in one of the Kevins, and they're going to juice the economy by slashing rates even more. So risk on, buy coins. That might be a kind of unnecessary distinction, but there is a distinction there where, like, I don't really think it trades as any kind of safe haven in any way.
No, I think it's a liquidity play.
Yeah.
I agree.
Yeah.
It's more like but again, it's all the same thing. I think that any sort of like uncertainty around the value of the dollar, I think that's the bigger tell.
Well, dollar's firming up. The dollar's just like creeping again.
Today.
Yeah.
Today.
Well,
But I
take it
wouldn't.
back.
I mean,
Yeah, take it back to December, because I'm watching the 10-year. The only reason why I might be a stickler on the dollar is because if the 10-year gets through 4.2, Danny, I think that dollar might wake up.
yeah, I agree. That's like another area where it's like
But it's a big
the
if.
10-year goes. Right, and that's a big focus of the administration is keeping rates lower, especially the long end. That seems to be a big driver in getting mortgage rates down and making housing more affordable.
Right, and that's why I'm afraid they're literally going to do the opposite, because they're going to think, like a lot of people still do, that cutting rates brings down treasury yields, but we saw in the last 2 years it doesn't necessarily work like that. So you could blow out
but rates
the
aren't
long
going to be cut till June. I mean, not until Powell's gone. It looks like he's done
Fair,
cutting rates.
yep.
I mean, he might even stay on now. So, which maybe that'd be good for the 10-year, the 30-year. But longer term, it's like there's the QRA is the end of the month, and we'll see where the Treasury issuance kind of shakes up. If they try to do
True.
less long end, more bills, they kind of juice the long end. But again, the entire focus of the administration seems to be housing, home affordability. So it's like you can push back on that, but I think that's kind of it's very challenging.
It's very challenging. I think it's an admirable goal. I think there's probably ways to do it, but there's always risks when you start tampering with public markets. One of the big things that a lot of people like to talk about, obviously, is how the big asset managers are buying up real estate. It's kind of where I find it hard not to default to my like rabid free market mindset again and just say, look, if they're going to take on the risk and set the price, then the rest of us got to find a way to keep up. But here's what I would say, Danny, is all of this basically, to your point, they're not going to be able to start cutting rates until June. That leaves basically a 5-month period where the market and all its participants can use their imagination about how good this all might be. And I think there could be some life to that. Maybe you buy an ITB for new home construction. Maybe you ride the Russell,
Yeah, that's our firm view. We're very gung-ho on the broadening out trade. To the credit of our eco team and policy team, they've been flagging these big refunds coming since November. They've been, and our furniture analyst has been super bullish on names like FND, Wayfair, SIG, the mattress company, or is it SGI or SIG? One of the two. SGI, sorry. On the mattress side,
is
and
that
then
Tempur Sealy or something?
yeah, it's like they have a total monopoly on mattresses. And I'm serious. When they
Somna Group, SGI.
yeah,
Okay.
yeah. So they own, it's like 80% of all mattress sales go through
Hey,
this
the
company.
chart looks like it's got an ascending triangle, like it could break out big time past $94.
Yeah, and we're bullish on consumer and the broadening out, which is unique for our firm to be so bullish consumer. But the view is, one, you have an accommodative Fed, you have huge fiscal stimulus coming in the form of refunds between February and March, and so we've been very much on board with this broadening out trade. And then even today, our mortgage analyst, he's like, I like NLY, he likes AGNC, likes RKT, names like that could continue to work. UWMC, like all these mortgage refi names that, again, as you move rates lower and you get people sort of moving, you get housing to kind of wake up. That movement, we think, should continue this broader term rally. And you don't need much market cap leaving Google to get a name that like SGI, that's $20 billion market cap, to rally.
Well,
So
here's what I'll say.
as that money sort of maybe gets sprinkled around a little bit, you can have these names that have been left for dead start to work. And a lot of these names have been left for dead.
Well, it's coming out more of Apple than it is Alphabet right now. Google.
Sure.
That chart looks pretty darn good.
Meta,
Number one AI.
the other one.
Yeah, exactly.
Meta and
Or Meta. Meta looks weak. Amazon, maybe mixed, yeah, but did pull back pretty hard the last couple days. The 1 year chart for Apple is like, depends on where your starting point was. It's getting kind of rough now over the last month and a half, but it's stabilized at 260. But a lot of mags are just kind of going in circles.
Yeah, Amazon and Apple might get a little positive catalyst if we get a NAIPA decision in the next few weeks, because our view is like, while he'll still reinstitute a lot of the tariffs, not all of them will be able to, and we think the rate will come down from around 12-ish% now to 8% after if they're deemed illegal, which I think it's like I think it's like saying like there's a 2 in 3 chance that's what's going to happen. And he might use that as an off ramp to refocus on affordability. And and as a way to sort of help the consumer, which again would be bullish to these stocks. I don't know if it's bullish to the long end, but should be bullish to these stocks.
SGI mattresses, ITB home builders. I mean, the key thing is it needs to have a big enough impact to get new home construction going and/or getting people moving out of their old homes. But that just seems like a much tougher thing. Better is to stabilize the economy and maybe get some affordable housing online. That seems like the way to do it, but the home builders need some incentive to do that right now. Yeah, they don't have the incentive really to do it right now.
I think if you could bring mortgage rates down, that should reignite demand, and perhaps you get the midterm resolution you want if you're a Republican. That's, I think, the goal for all of this. It's like you've got till the midterms to try to turn the narrative around, make things more affordable, and that's the agenda right now.
Okay, Dan,
whether or not it works is unclear, and I agree with you. I think the best hedge is something like a June TLT put. Rate vol is extremely low. We've been buying puts in like an LQD. That's the insurance.
Okay.
That's the IG.
Okay,
ETF, that is like a 10-year.
Today.
That is a 10-year. Yeah, that is a 10-year duration. So it's like, I think the biggest risk of this entire call is the long end goes up. If they can't keep the long end down, it's all over anyway. But you could just trade that directly. You can buy puts on TLT. You can buy puts on LQD.
Yes.
You can go out to June. Volatility is like the lowest I've ever seen it, and then that's your hedge. And on top, and then you can own higher beta stuff on the long side. Calls on like a RKT, calls on FND, Floor and Decor. We like Wayfair, stuff like that. WHR. Whirlpool, whatever.
Whirlpool.
Yeah, just to play all the same thing.
All those short-term charts are looking pretty good. I think you might be onto something there. I guess I didn't realize Redfin also just hit 1 year highs, monthly. Yeah, I like that. I like the housing idea, Danny. I also know that the small caps, and I also just like the way to hedge it with short bonds, because there's also a scenario where yields creep higher and stocks keep going higher. So, you can win in a lot of different scenarios instead of trying to outright short equities when you've got SMH just making all-time highs and broadening. I just don't think that's a good idea. So you got to find a different creative way to hedge outside equities. I do think it's bonds. Give me a trade. Give me the way you package Russell right now. Are you trading it directly IWMs? Because I feel like it's probably your most frequent trade in our conversations over the last several years, Danny.
I mean, IWM we've liked on the long side. I think it's sort of like a stay away here. With like this breakout, we'd rather own some of the consumer names. Generally, I'd say probably when I'm on this, I'm pitching puts or put spreads. I feel like I have a hard time getting super bullish on Russell ever because these stocks aren't as good as don't have as much pricing power as some of the larger cap names. Obviously, it's breaking out. It's done really well. I think some of that's also seasonality. It's a time of year to take risk, and we're seeing this broadening trade play out. It could continue to work. I'd just rather own housing related names to play this theme. And we sort of missed it. To some extent, sort of missed it. Feel the same way about silver.
Floor and Decor, F&D, one of them.
Never been there, but we like the stock.
Never been there. Love the name of it too, Floor and Decor. Yeah. Wow, it's like almost French.
Very descriptive.
Yeah. Emphasis on the decor. Silver thought before I let you go, Danny. Chris Brecher's on deck. He's got some fun geopolitical trades for us, but give me a silver thought real quick. Is that it's not like gold, right? This is a totally different beast at this point.
Oh, I mean, I'm just gonna continue to lose premium buying puts until it breaks.
I know that one.
I'm just gonna do that.
Bit, right?
Yeah, I'm just gonna do that forever until it breaks. I will be right eventually. I don't care if it doubles again from here. I'll be right eventually.
It's a weird candle. I know there's a name for that one. I don't know it off the top of my head, but you got that long.
I mean, like to be frank, candle. I don't mind something like a March 70-60 put spread. One other thing that someone mentioned to me, and I think this is kind of a good idea if you want to play this space, and I think it's more interesting in gold, is you just buy gold puts by the underlying stock. And he's like, well, if gold sells off, I'll sell the puts and keep the gold. And I think that's the way people view gold. I think silver is maybe you buy puts and buy the stock, and you just, if your puts get in the money, just exercise them and move on.
Okay. I mean, pretty nice comeback after hitting 85 today. Silver futures, $92. They're definitely.
Well, it seems like they keep increasing margin. They keep increasing margin estimates on. That's the part I have. I'd rather own copper.
And the fact that that hasn't broken it though, it tells you there's some serious meme mania behind it. It's even getting more expensive to trade, and people are in it. Copper is going to be more of a slow moving, but I think it moves in the same direction.
Yeah, I think it'll keep going up over time.
Chamath Palihapitiya is in it.
Well, I don't know. That's a good bad thing. Well, then he's talking about it and looking for liquidity.
Right. All right, good stuff, Danny Kirsch. Always fun. It was a pleasure. Thank you for being here. Head of options at Piper Sandler. Danny, great stuff.
Thanks for having me.
You got it, sir. Good stuff in there, like the housing trade, like the hedge with short bonds. Chris Brecher is joining us next. We're going to talk about what to do if the U.S. is going to go into Cuba. We got some fun trades for that one. Who knows what's on the list? Greenland, Cuba, you name it. We're going there.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
All right, we're back. Stocks holding in pretty solid on the day here. We talked about some of the metals as they took a little bit of a break. S&P 500 up 0.25%, has cooled off a little bit. Kind of been a slope downward here for the last hour and a half or so. Not the worst. We're still up on the session, but we are losing a little bit of steam here, looking at where we were at the highs, 69 to 80 for the day. Russell, though, as we just talked about with Danny Kirsch, looking very strong. IWM's holding in. Russell's up 1%. Rotation looking pretty real out there, and it might be coming from some of the metals that have done so well. Gold is down 0.5%. Silver is up today after being down on the futures. Still going to get a red candle, and as we just looked at copper as well, down 1.3%. So copper hurting a little bit there, but not exactly the worst after just making highs. We got a lot of things in the metals camp that a lot of folks have attributed to geopolitical subjects. Chris Brecher joins us from TradingNest, and a nice Cboe shot in your background there, Chris. How you doing? Welcome to the show.
Thanks for having me. Basically, the S&P pit is now where IBM was.
Right, exactly, right? So, right back here, right behind me.
And
you were here.
stood in the same spot for 8 years.
Tell me about what you traded. What were you doing here, Chris?
I was trading the IBM pit back then. Are you asking what I did back then or now? I just traded premium a lot in the IBM pit and traded against the crowd, but I really combined charts, which a lot of people didn't back then. They more went on expected moves and the public paper. So it's pretty wild to be in a pit of 100 people and take them all out of a trade because I thought the chart looked bad or something, because it was totally opposite what everybody else did. So it was, it was real interesting, and it was a lot of fun. A lot of people say, wasn't there a lot of stress? I'm like, how many places can you get rid of your stress by screaming and yelling?
Exactly, yeah.
Working for a day trading firm when you have to sort of keep your emotions in that stress.
No, it's true. It's why it's the pit, you know. You get a nice little rush, you know, at your job. I was reading, that's part of the reason why I wanted to have you on the show, is I was reading your bio about your time here, and you had a pretty interesting story about spending up a couple $100 from your parents.
Yeah, basically I worked, this way before your time. But when I graduated,
you said you parlayed it into 23 G's in 2 years. Not bad. I got it up on the screen right now.
Basically, you know, Wolf of Wall Street, I started with a boiler room. In 1981 with this schlock firm. And everything you've heard about Wolf of Wall Street was true. I hate to tell you that, but it was true. And basically everybody there was a big bear market. Everything they touted lost money. They all took shots and options, and they were all losing. I'm like, well, I want to be the house. So I went to work as a clerk on the floor. And after a year of learning it, I went to work at a discount brokerage firm taking orders over the phone. But I got to trade my own account commission free. So that's how I took the 200 and turned it into 25,000, then got in a seat on the floor and was there for 8 years.
That's pretty cool. I love that. The trades that you're doing today compared to kind of how you started out, there's obviously all these different ways to trade now. There's, you know, we've talked a lot about event contracts, but mostly, you know, the core is options here and what we're thinking about. And a lot of people have been able to get very smart in options. They've been able to monitor second degree, you know, types of flows, second derivative type of movement. For me, you know, I still keep it pretty simple when I trade. I generally use spreads, and I generally am using them to hedge, you know, positions rather than taking big speculative ones. How do you think about most of your trading today?
I'm on the same boat as you, especially when I'm recommending trades to people or they're watching me. I'm a lot more conservative than just like going and buying 100 lot of an out of the money put or a call. I could do that, but when you're doing zero DTE, you have to react so fast. It's hard to then transmit the exit. So we're doing a lot more like spreads, like you're talking about doing. And definitely we're doing spreads in the direction I think it's going. So we're not just blindly going neutral. If we're bullish on a stock, we'll do bull spreads over the market. We won't usually do them like one day out. We like some to be able to lay off the risk in there. So we're definitely trying to lay off the risk going farther out.
You're a trend guy. You're a trend trader essentially, right? I mean, I know you do a lot of chart work. I was looking at some of your stuff, and I like the chart work. You know, technicals and thinking about things technically has allowed me to try and be as impartial as possible, both as a host and a trader. Tell me about what charts you think look good right now. What looks like is in trend to you?
Well, I'll tell you, is the beginning of the year, I was asked, like, what stocks do I like? And my favorite was Generac. In fact, I do crazy ideas for 2026 on YouTube. My first one was about Generac getting taken over. It's not taken over, but it's gone up 20 points in 2 weeks, which is pretty cool. That's a hurricane stock. So if you look at the chart on the right, you could see it actually tested like the prior tops from a year ago, way back there, 138. So if you look down there.
Oh, yeah, I see it. Yep. You got some support right there. It just bounced off the support here.
So the whole idea is not to just buy it there, but then to look for a turn, which you got. And it didn't hurt that it was the beginning of the year, so some tax loss selling was gone. So, and it popped. The other thing that historically goes up after May earnings because of hurricane season.
How are the hurricanes this year? I don't know.
Well, it was amazing that last year.
Not here, luckily.
We didn't have any hurricanes, but it sort of stayed up because people are expecting higher power demand because of AI and backup power.
Right. Yes.
I think that's why it stayed up, and I think that's one reason it stayed up now. But I just can't buy it in here. Now it's overbought at resistance. I'd love to see it settle down and test the lows down there and then grab some spreads going out to August above the market.
Yeah, to your point, it's been this bounce has brought the RSI up pretty high. It's still in this downtrend too. So what if it gets on the other side of that line, though? If it starts trading 170, is this the type of thing that can move quick?
At this time of year, usually it settles down into the May earnings.
I see.
And they have the Feb earnings coming out, so I just sort of back away. So, I mean, I miss things all the time. So if I miss it, there'll always be another time. I know that's sort of corny, but I miss things all the time.
That's an important part of it, yeah.
So I'm
big pop on the July earnings. This thing definitely moves a lot on earnings, to your point. This is a stock that when it delivers information, it changes direction pretty quickly.
Yeah, exactly. And but I would rather mess around going into like July and August and get in right after May earnings.
Okay.
I mean, that's just worked for like the last 4 years. And by the way, one thing sort of neat on why I thought markets would go down today, it's that open interest at 69.50.
Okay.
So
tell me about what you see on the index level.
Well, the charts, number one, you had that resistance, right, like you see on the right, about 69.79 of just even on an hourly chart.
Yeah, exactly.
So you saw that right up there. But that didn't mean to short it. If you went to, let's say, a 5-minute chart, you could draw a defined upward trend line. So right there on those two little twerks you had over there, underneath, you could draw that upward sloping trend line. And that was the ticket, 69.70, to play it to the strike price at 60. Yeah, exactly, right in there.
I see.
From there over. And then, like I said, you don't know. Yeah, exactly, right there. So the key isn't that you shorted at 69.79, because you don't know if it's going to 7,000. The key is to initiate on that break in the trend line, betting on the open interest then mattering, which it has, which is sort of neat.
Do you think this is short term or some kind of sustainable move? Because it seems like there is a bit of a chop right now that's real. We can't break down, but we also can't break out.
Yeah, it's a good question. It's funny because when I was on the floor and you had brokers that would come in with orders, there were certain brokers that you faded. They were always wrong. But you have me on right before a Piper Sandler, and they're great. So, I mean, it's just you don't fade them. And I agree with them about It's not necessarily the SPX that I'm cautious on. It's the Russell because it's just too darn extended.
You think?
And I also agree about long-term rates. The problem with the long-term rates, and if I think long-term rates are going higher, it's a lot of times that's a symptom of the economy being really hot, which can
Fair
make
enough.
March.
And that's definitely, that's what we were talking about. That's the June time frame. Once we start cutting, I think everybody's kind of seeing the same cards coming that way. I'm just putting a little circle on the overbought for RSI there in IWM. You're right, it just did cross 70, so it's a little bit hot, but it's been kind of the stepchild for a long time. So why not let it have a little moment in the sun, Chris?
Well, that's true. The thing is, when it comes to the SPX, a lot of people cautious. I'm looking at correlated world indexes, and I'm watching the Japanese market, the German market just exploding. So it's usually they lead to the downside. So if they are having another leg up, you can put the /NKD. It's just going straight up.
Right.
It's really hard to fade the SPX.
Yeah.
Maybe for the day of that open interest kind of
point. That's a good point. Rest of world's ripping. We're the leaders. What are we going to get left? I mean, look, there was a period in the first half of this year, international did outperform U.S. a good deal. It had a nice catch-up trade there, but ultimately those have been fairly short-lived trades for the most part on the long term.
I'll tell you right now, though, is the German market led to the downside like in January and February. And when the U.S. markets were down in the dumps back in April, the German market was going to an all-time high already.
Yeah,
so
that's
that's why I wasn't
30% in the last year versus 17% for the S&P. So maybe even if S&P does drag its feet a little bit, like it has been the last year compared to the rest of the world, it doesn't mean to short the S&P.
No. I'm looking, what we've been doing, for today, what we've been doing is looking that if the markets came back to that 69.50, what was acting the worst? Mm-hmm. So those were the stocks we were trying to fade for the day. I'm talking about day trading. Because we were like, if the market does go to 7,000, well, they were already acting poorly. They're probably not going to move much. If the market goes to where I think it is, maybe not play the 0 DTE, but play the cheap puts in the apples. Because all day they had acted poorly.
Yep, Apple does look weak. Apple's looked pretty weak. NVIDIA looks more range-bound to me, like it's just stuck, like that's kind of like a rock. We hope that doesn't sway to the downside too far, or else we might have real trouble. I know you were watching Rigetti, right? Kind of another one that's built a little bit of a base.
Yeah, it's funny that it's Rigetti and I call it Rigatoni, and it's funny because somebody I follow really closely, Helene Meisler.
I love Helene. She's the best. Yeah.
She calls it Rigatoni.
She calls it Rigatoni? That sounds like
I didn't realize that, but longer term. See, here's another one about longer term. I think it looks really good. And here's another one where I'm not saying to buy, let's say the 26 calls for next week. But if you want to do a spread, let's say going out before earnings, I hate taking shots on earnings. Mm-hmm. But if you go up to earnings and do, let's say, a 22, 27, 29, something like that.
Okay.
So a broken wing, because in the grand scheme, like you were saying in some of the other stocks that were still in downtrends, like GNRC, this might take a long time for it to really break up. So that's why I like doing like broken wing flies and stuff, where maybe I'm not going to make that much, but we're trying to use time to our advantage by laying off our risk with like buying a vertical call spread and selling a vertical credit spread to pay for it.
Okay.
Or some of it, and that's the broken wing.
Yeah, I like that. You don't get totally roasted if you're wrong. You get some flexibility, but you still get good payoff if you hit it.
Yeah, that's what we were doing with. We did it with some of the Cuba stocks we talked. We did it with.
There we go. You read my mind. Hit me with some Cuba stocks, Chris.
Yeah, and just so you know, like I said, the crazy ideas for 2026, I've only done 2 so far. The first was about GNRC getting taken over, and the other was about the U.S. annexing Cuba. But I came up with that 15 days ago. So it's pretty neat that came out before any of this Venezuela stuff. And It's more that sort of like Godfather 2 with Hyman Roth, where he owned all the casinos in Cuba and they were going crazy till the revolution. And you think if it's unwound, I mean, aren't the casinos going to go crazy again?
Well, so, I know. Okay, I see your point. I also am just thinking at the casino at home and the betting markets and what the AI is saying about possible invasion. AI from Gemini, currently #1 ranked AI, says U.S. isn't planning immediate invasion, but recent actions and rhetoric, especially what happened in Venezuela, have heightened tensions. And also we're talking about buying Greenland too, so who knows, what's possible here.
What's funny is the first priority, though, with Greenland and Venezuela before Cuba is infrastructure. Especially Venezuela, the infrastructure stinks, and that's why we're long Fluor.
Okay, all right, so let's go to the stocks now. I was starting to go down the rabbit hole there of, the odds of us. But let's just go, there would be stocks that generally relate to, how would we invade them? Do you buy drone stocks for Cuba, or do you buy gaming stocks, or what is it?
What's funny is I have my own ideas of which ones, but using your AI doesn't hurt either. And it pops out the Vulcan materials, the Fluor, the casinos, the hotels, the airlines, the cruise.
I see.
And
so it's
really
travel.
Yeah, in order of it, I got to say the infrastructure first. Okay. And then I would say the casinos. And it's not so much that it has to happen. It's just the perception, if it could happen, could really help the wins and the floors go up. But that's why I'm not buying calls.
You're talking Wynn Resorts.
Pardon me?
Wynn Resorts. Like Steve Wynn's going to put up shop, right?
Well, we bought it. We bought that. See, here we go with being conservative. Sure, I could go and just buy like the February 120 calls. What we did instead is a very conservative strategy of buying the 10, 20, 25 broken wing for like 330. Okay. So March. So that even includes earnings. So if it implodes, it's probably still going to be worth 3. And if something does happen, it'll immediately go to the maximum, like 5. So it just seemed like a risk reward.
That's fun. All right, so Wynn, FLR, Fluor, more the build out, right?
We did a Fluor today, which actually we're in too early, but that's the thing. That's why we went to March, because I'm not trying to exactly time this. Even though the chart looks okay, it's more if something happens.
It's a choppy chart for sure.
Not doing big size because I like to have 3 reasons to do a trade, and it hasn't broken up yet. But that kind of idea. So in there, we were looking at the 40, 45, 47 and a half for $1.49. We sold it already at $1.99. That's what, 40% already, just on a perception. And now we rolled into the 40, 47 and a half, 55. We did it evenly. I don't think Fluor is going to go up 15 points.
Okay. The Chat GPT, or rather, I should use the correct brand I'm looking at, Gemini, has a little bit of different ideas. They say defense contractors, energy. I guess the cruise lines have got to take energy, more defensive stocks, and I don't know, they say utilities, healthcare. I'm with you. I don't think we really need Lockheed Martin RTX to take over Cuba. I think we just drop a few dudes in SEAL Team 6 like we just did, and you buy Wynn. Buy Wynn Resorts, baby, or FLR. Chris, fun idea. It's good to have you on.
Yeah, thanks for having me on.
Great conversation. Love the specifics.
All right, take care.
You got it, sir. Chris Brecher, TradingNest.tv. I like the Cuba trade, too. That's a pretty fun one. I'm out of here. Thanks for tuning in. That's the closing bell. Stocks did drift a little at the end there. S&P 500 finished the session 69.44 and a half. So futures settle. I will see you next week. Have a great night.